There's a lot of restaurant franchise brands out there, but is the best restaurant stock a brand you've never heard of? Well, I've actually talked about this before. We're talking about Olo stock. Over a year ago, I did a video on Olo calling it out as an exceptional business, but the valuation was too high. And I called that out saying it was too rich for my taste. Valuation matters. Valuation can turn a great business into a terrible investment. It can also take a terrible business and turn it into a great investment. That's why valuation matters. Since I called out that video, as you can see, the stock has gotten absolutely clobbered down something like 70-80% since I made that video. Just absolute bloodbath. A quick recap of what does Olo stock do, which I'd argue is one of the best businesses in the restaurant sector. Well, they actually don't run the businesses. They don't run the actual, restaurants. What they're doing is they're effectively providing the operating system that makes these restaurants possible with basic functionality like being able to accept payments or having drive-through functionality and get, having delivery, takeout, reservations, waitlist, dine-in, options. So having, saying, hey, this is where they're going to sit. They're going to sit at table 2 or table 3. And so this is the core operating system for several restaurant franchises. And they have over 600 restaurant brands that effectively are their customers. Those brands have 82,000 restaurant locations. So this is tapping into a lot of the restaurants that you might be going to. And they also have 300 different technology partners that enables effectively the Olo platform, which is really interesting. So of these franchises that, these brands, they pay on average around $500 per quarter, around a couple of $1,000s a year. You have tens of billions of dollars effectively in money, effectively business that's processed through them and powering more than 2 million orders every day. And so the reason why Olo is winning is you have these brands, but you also have tech partners that are directly integrated with Olo's platform. Olo doesn't necessarily offer everything. They might have like a geofence partner that says, oh yeah, we'll help you, if you want to have some sort of delivery option, whether or not you want to work directly, let's say with Uber Eats or DoorDash, or you want to manage it yourself. You want to have sort of your own fleet of drivers. We have that functionality, but we don't necessarily have the geofencing technology to say, hey, this is the range where you'll be accepting orders from. Yeah, we'll work with a tech partner that will enable that. By effectively working with 300 plus partners, it makes Olo's value proposition richer, which ultimately results in effectively making it possible to serve more guests, which makes it possible to have more brands come on board saying, oh, this is a very attractive platform. And so the more brands you have, the more partners want to come on. It's a beautiful flywheel business model that ultimately should win over time in this space. You're not going to have, dozens and dozens and dozens of competitors over time if you have a player like this that's taking share year after year. And management thinks they're tapping into a big opportunity saying, look, only 15% of restaurant orders are digital. I'm a little bit skeptical about all this sort of opportunity management. Further goes on, Olo's looking at 100x US enterprise opportunity, talking about how they can expand their locations by 4x, effectively digital entirety with all of Olo's different options. That's another 6x, so more orders per location. And then using one of their latest products, Olo Pay, they think that could help drive another 4x. You multiply that all together, you're talking about 100x growth potential that they're saying, hey, if you get all this, that, just absolutely tremendous upside. I'm a little bit more conservative thinking about that because look, they currently have around, I already called out 82,000 locations based on the 600 brands that they're working with. Well, based on the enterprise restaurant brands that's a total addressable market, that might only be like 400,000 locations. So really okay, so that 4 or 5x upside. So you do have to sell, are you really going to capture all of that? Or are you going to split the market maybe, 20, 30%? A lot of these players, they might find there are definitely a lot of competitive offerings out there. So it's unclear. Yeah, you're really going to capture it all. And so is the addressable market really 100x, or is it really, talking about maybe 5x potential over the next decade or two, which could still drive, very nice growth, especially when you think about, hey, there's also international, which they can start getting into, which, should add, let's say, another couple 100,000 locations. So maybe you're talking about 1 million, right? Sub 1 million potential locations for the enterprise, or they start sort of shifting their business model from the enterprise to working with small and medium brands that might only have one-off locations. That would be a bit of an overhaul from their model right now, but it is possible they go downstream in the future. That's really not what they're doing right now. Right now, it's about tackling the enterprise that they're looking at. And so looking at what they've done historically, you're talking about 120% net recurring revenue, which is really interesting to see because 120% net recurring revenue means that if they didn't win any new business, any new customers, their prior cohorts, just based on their business model, upselling and taking a piece of effectively the transaction revenue, resulted in 20% growth historically. But when you look at more recently what's gone on, they're only at 106%. So that means only 6% expansion from their existing customer base. That's because they've lost some key partners / customers with DoorDash and Subway. Subway had tried out effectively their delivery module, and now they're going directly with the delivery, partners. So instead of using Olo to help deliver, some of the Subway sandwiches, they're now working directly with the various different delivery options. There's also COVID sort of it was a boon to the business last year. Now you're sort of lapping a period that was very strong for them. That said, management does expect to get their net recurring revenue back to 120% in the future because they're saying, the challenges we faced really have been with the delivery module. The pay module and ordering module, they think, this is still doing really well. There's all these other solutions, front of house, guest engagement solutions. This is the core value proposition. Delivery's been a little tricky because, how much can you charge in terms of uplift for a delivery, and does it potentially, sort of people start fighting over the economics for it? But they're saying, our core value proposition with the end restaurant is really sticky. And so they do think they're getting back to 120%. So just 20% growth just from their existing customers without even layering on new customers in the future. So that could drive a lot of growth going forward. The question is, where does Olo stock go from here? If you're struggling with this investment environment, consider unraveledinvesting.com for new ideas and a community of like-minded investors. In full disclosure, this is not financial advice. And so looking at their financials, even, recently, you see that it's unprofitable, but it's free cash flow break even or better, which is what I like to see, especially for a business that's trying to grow 20, 30% a year. Looking at their results so far in 2022, it has been greater losses, but they're still growing, high 20% growth. Their guidance for the year is low 20s, but still 20% growth. And for a company that's effectively saying, hey, we can sort of self-finance, not facing a lot of dilution beyond stock-based compensation, that is interesting to see. And here it is, the last 3 years, they're free cash flow positive, in large part because of stock-based compensation. But still, this is a capital light business model. I like it. And this is arguably why it's one of the best business models in the restaurant industry. I don't like seeing the insider selling, which you can see that there's been a lot of insider selling, even as the stock has gone back down to around $10 a share. But it is interesting to see Daniel Meyer, the founder of Shake Shack, the founder of Union Square Hospitality Group, which owns a bunch of different restaurant brands. He bought, $250,000. Now he's a director at Olo. And so this data point, I will never have the expertise, the insights that he will have as a owner of a restaurant to say, hey, this software is really good. This software. And so for him to be putting sort of money where his mouth is, that's really interesting to me to sort of see that. It does make me think, okay, the value proposition here is quite strong and he's trying to be opportunistic. Now, buying $250,000 for Daniel Meyer probably isn't that big of a deal, given that he's probably worth tens of millions of dollars, maybe more. And so it's sort of a rounding error, but it might be just a vote saying, hey, I do believe in this product. And a lot of the data points I'm seeing suggest, they are winning. They're still growing, high 20%. They are definitely taking market share. And it looks like they're offering what is a critical solution for their end customers. And so one thing that does give me pause when I'm trying to ask where does Olo stock go from here is the fact that, look, right now there is inflation going on. You do have a lot of folks struggling with the necessities like energy prices, where you see a lot of people just being struggling to pay for their energy bills. And when you have a business model that's effectively half driven by restaurant subscriptions, but the other half driven by restaurant transactions, it does make me wonder if that will come under pressure potentially in the quarters ahead. Now, management does say, hey, even if there's a recession, what you really see is the trade down effect, where people no longer go to the fancy restaurants, but they'll still, they'll go to, they'll get the Grand Slam at Denny's, and I'm living the life. Not trying to put down Denny's. But so you sort of see this trade down effect where people still want to treat themselves. I just wonder if you see that when people, start having trouble paying for electricity. And so if that's the case, we'll see. I'm a little skeptical on management's optimism there in terms of saying, hey, even if there's a recession, we should do fine. If this was 100% a subscription business, I'd feel more confident, but it should be, if the restaurants are feeling the pinch, how likely are they going to be say, hey, let's go try out a new module. Let's go pay for a new solution that, we're expecting to effectively pay for Olo. And Olo has talked about sort of the lengthening sales cycle. So I do wonder about that optimism. I wonder if you see a further pinch in the business from here, because it's very clear that at least, economically, you are seeing, a slowdown, and the Federal Reserve is continuing to tighten. So it makes, suggests that you haven't seen the worst of effectively the economic slowdown. And so then it comes down to valuation. Of course, this is a hypothetical valuation framework. Of course, stock prices go way higher, way lower. I am interested when I see a stock price down 80%. And so I start wondering, well, is that compelling? And I think a lot of folks miss the fact that, what's the difference between a stock, that's down 80% and a stock that's down 90%. And the reality, it's another 50% drop. And so I just wonder if you could see something like that here with Olo. Of course, it could be volatile, but looking at it now, first of all, the share count, a lot of people might get thrown off by it, but the reality is it is closer to 200 million shares outstanding, which is around $1.5 billion market cap. You won't see that with some other sources. So then looking at, where this business is, where it historically had very fast growth, 50% plus for several years. This year, they're guiding to effectively around low 20%. So I'm penciling out 20 to 25%. They're not here yet. But given this model of effectively offering the operating system for restaurants, I'm penciling out 25 to 35% optimized profit margins in the future. So they're not there yet. There's going to require a lot of execution to get there, but they are already effectively at free cash flow break even. So I think there's a good chance they could get to something like this in the future. Throwing on some sort of tax rate, sort of saying if they were at these margins today, then it would be trading around a 30-something times multiple. Relative to the 20% plus growth rate, that's okay. Not deeply compelling. Looking at a sales multiple around 8 times, that's okay. Once again, not deeply compelling. The question is, what's the growth rate in the years ahead? Do you think, management's going to be right and they get that 20% minimum just from their existing customer base and then layer on existing customers, in which case they should be growing closer to 30%? Or do you think it'll be sort of a tough slog in the years ahead where, people may not be as excited to go out to eat? And so I'm putting, the or ordering in. And so saying 15 to 25% annualized growth in the years ahead, maybe this is too low. Maybe I'm being too conservative, but even still in this sort of range of scenarios saying, hey, this should be viewed as a very sticky operating software business. This is like the core OS for a restaurant. So I am applying a higher multiple, even though I'd argue this growth rate isn't crazy compelling. The 15% I'm assuming on the low side, but 20 to 25 times for this business 5 years out. They do have a lot of cash on their balance sheet. You got to give them a lot of credit there. Nearly a third of their market cap is in cash. And when you think about, well, how do I blow up as an investor? There's really 3 ways to blow up as an investor. You either overpay, which a lot of folks did, and the stock's down 80% since then. Because of that, they've had pretty solid execution. Another key aspect is, you effectively have a business that doesn't have enough cash, or it has too much debt. And so when you see something like this, where you have this nice cash-rich balance sheet, you've automatically removed one of the one of the key 3 risks that you have with investing. The third sort of key risk when you think about investing is sort of what are the various different business risks that business has. And, I've called out some of them, like the fact that they are going to be tied to the economy, and sort of asking, this sort of this challenging dynamic with the delivery aspect of who wants to own the economics. I like the position they're in, though, because when you effectively aggregate demand and you represent the restaurant, that is a very strong position versus sort of the consumer. The consumer isn't always, I don't think the Uber Eats app or the DoorDash apps really fully own the consumer. I think the consumer will occasionally say, I want this restaurant. Now, they might occasionally say, let's just browse around to see my options. But if they say, hey, I have a hankering for this, then it's really the power goes to the restaurant. And the restaurant's choosing, okay, this is how we want to deliver. And we might be using Olo's rails to effectively do that. It might be a fleet of delivery drivers that they manage, or they directly integrate with a delivery app. So it is quite interesting to see that. And so looking at this, given how much it's down, trading around 8 times forward sales, lower than that when you adjust for cash, I think adding back the cash 5 years from now, thinking about what this business valuation potentially looks like, I don't think it's that bad. I don't think it's, I think investors here will probably do better than the S&P. That's what I would personally bet on it. Like I would think that this, over a 5 to 10 year time frame, I would think that this does better than the S&P 500 because, you're looking at a higher quality business with higher growth rates. Yes, the valuation's higher than, let's say, the S&P, but over time that you should be compensated for that, just given the fact that the growth rate is so much higher and expected to be higher for years to come. And I'm not really seeing the data points saying, hey, their value proposition is getting eroded away. I've seen that they've seen some challenges from, let's say, Subway or DoorDash, but broadly, I'm looking at this, I'm saying, yeah, it wouldn't surprise me if you have a really tough period over the next 5 years, if the stock is just barely up, but it also wouldn't surprise me if you see, let's say, 100%, maybe even 200% upside, if I'm being too conservative with their growth rate in the years ahead. I think, I'm looking at this and I say, this is pretty good. It's not deeply compelling for me personally. I try to call out things where, at least for me right now when I'm investing, I want to find things, and given the framework, and I've done several videos, oftentimes I'm doing videos on individual companies, but I'm also calling out, is my thoughts on the macro and sort of what I'm seeing out there and what some of the great investors are doing right now. And in this environment, I don't think it's prudent to ignore headlines like 20 million U.S. households struggling with energy bills. And what the U.S. is facing, keep in mind, pales in comparison to what is being faced in Europe. So I think you shouldn't just read that headline and then just go, oh, I'm going to buy this stock because it's cheap. It's not cheap, that dirt cheap. It's still 8 times sales. It's not like it's printing tons of profits. And so I'm very cautious in this environment. I can understand others saying, oh, this business is so, high quality, it's a buy. It goes back to that idea of, what's the difference between a stock that's down 80% and a stock that's down 90%? And it's that additional 50% drop. That wouldn't surprise me here. Wouldn't surprise me if you see that over the next year or so. Over a 5+ year time frame, though, I think they're probably winning just based on the data so far. So far it looks like they have the winning, value proposition that's taking share. And when you see insiders like Daniel Myers, I think that was his name, from Union Square Hospitality, when you see, a guy like that who has the inside information of, okay, this is what it is to run a restaurant, and he buys even just a little, that is sort of a vote of confidence. It makes me say, okay, their value proposition is pretty solid, and their growth rate does suggest that. The challenges come from a very specific segment of their value proposition, which is tied to delivery. There are other things, it really does seem like they're trying to figure out new ways to sort of make sure the restaurants are pleased. Like their Olo Pay has a functionality where it's enabling effectively these restaurant brands, to have a digital wallet, so that way people don't have to even give their credit card every time. Oh, it's just saved in the digital wallet, so it's sort of this frictionless payment. Well, the lower the frictions, the more transactions you're going to get, in which case everybody wins, because the brands get the business and Olo gets a transaction fee. So I find it to be an exceptional business model. That's why I think Olo is quite possibly one of the best restaurant stocks out there in terms of business models. At this valuation, I'm not saying it's crazy compelling. Wouldn't surprise me to see it up 100% plus over the next 5 years. But I'm personally want to wait for more compelling value personally. If you enjoyed this video on Olo, please make a point of hitting that thumbs up, hit that subscribe button, and thank you for watching Unrivaled Investing.